Afternoon and welcome to the first workshop in our Bookkeeping Practices for Small Businesses series, hosted by ANCA Center for Pandemic Response in partnership with the SUNY Canton SBDC. My name is Mihaela and I'm a program navigator with ANCA CPR. Brief agenda for today, we're going to go over some housekeeping for this Zoom session. We have a lot of new folks joining us today, so I'll give a brief introduction to ANCA and CPR, and then we'll move on to the main presentation. So a few notes before we get started. This event is being recorded, and the recording will be available on ANCA's YouTube channel following the session. We'll also share the recording directly with everyone who registered. If you would like to update your name as it appears on Zoom or add your pronouns, you can click the participant button at the bottom of your screen and select rename from the drop-down options next to your name. And feel free to introduce yourself in the chat if you would like as well. We do ask that everyone remain muted during the presentation, but you can type questions into the chat if you have them, and I will read them aloud. And we will also have time at the end for Q&A and discussion, at which time I can read any additional questions from the chat, or you will be able to unmute yourself and ask questions out loud. So a quick introduction to ANCA Center for Pandemic Response. ANCA is a nonprofit based in Saranac Lake, and we serve the 14 northernmost counties of New York State. We are looking towards a new economy that works for all, with the aim of building prosperity across northern New York by creating and sustaining wealth and value in local communities. We do that across these four main program areas: small businesses, food systems, clean energy, and diversity and inclusion. And the ANCA Center for Pandemic Response within our small business services acts as a single point of contact for businesses, nonprofits, and entrepreneurs to access these programs. We also work with a number of great partners, including the SUNY Canton Small Business Development Center. And we're also joined by Michelle Collins in this program today with the SUNY Canton SBDC. So if you'd like to connect with the SBDC, she is a great resource and we can connect you with their programming. In addition to attending some of our programs, these are some of the ways that you can become involved with ANCA CPR or start working with us. And already by joining this program today, you'll continue to be updated on additional programs and resources as they come along. Speaking of which, we did just want to let everybody know about a program that kind of leads off of this bookkeeping series, if you're interested, called Point Positive 101 through Clarkson University. This is an in-person workshop that if you're looking to learn more about accounting or accessing funding, mentorship opportunities, you can sign up for this free program as well. You can just go to pointpositive101.com if anyone's interested in that. We thought it might be of interest to folks who are joining this program as well. Okay, before I hand things off, I'd like to introduce our presenter for this series, David Reichel with Century Acres Business Solutions. Dave received his bachelor's degree in business administration from the State University of New York College at Oswego in 2009. Throughout his career, Dave has worked for Fortune 500 companies as well as small businesses. Having filled roles in frontline management and upper-level director positions, Dave has worked with clients covering a vast range of industries throughout the United States. While working with the Genuine Parts Company, the parent organization for Napa Auto Parts, Dave had the opportunity to train budding entrepreneurs to take over and operate their own independent Napa stores. These experiences inspired Dave to begin his journey towards small business ownership. That, I'm going to hand things over to you, Dave.
Thank you very much. Good afternoon, everyone. Thank you for joining. I will get my screen sharing here. There we are. So thank you again for joining. And I just wanted to let everyone know that this is a little bit of a new presentation for us. And if for whatever reason we run a little bit long or beyond what our time allows, we will pick up in our second workshop in a couple of weeks. So we won't miss anything. We'll be able to cover whatever content that we might not be able to get to. So bookkeeping, it's a scary thing for some people. Most of us aren't trained directly in bookkeeping. We are involved in our businesses to work with the core competencies of whatever that business operates to do. But it is a necessary evil, so to speak. And so we're here to talk about it. Why bookkeeping? One of the things that is very, very important for businesses of any size is to clearly understand and see where your money is coming from and where it's going. What streams of revenue, what types of customers are shopping with us and doing business with us, and what expenses are having to flow through the business. And at the end of the day, the ability to see our bottom line, hopefully profitability. Am I profitable? Am I wasting money? Am I spending money in multiple areas that I could trim down and find ways to reduce my spending? Can I create efficiencies and by doing so put more money in my pocket? Am I collecting all of my money? Are my customers paying me on time? Do I have accounts receivable that are going out and dating, and customers are getting some services or goods from us ultimately for free, accidentally? By having clean bookkeeping records and your financial statements, it allows you to do things like apply for financing and ultimately to sell your business. What is bookkeeping? Dictionary definition-ish is the process of recording and organizing financial transactions in a systematic and accurate manner. Bookkeepers maintain all financial transactions for a business and make sure that those transactions are properly recorded.
She took an extra chair too. We weren't sure about the chair. She wasn't, so but ended up.
Tasks for bookkeepers usually include reconciling bank statements, recording transactions, and preparing financial reports. An accountant versus a bookkeeper. They sound like the same thing, and there is a lot of bleed over between those two professions, but there are many differences. Bookkeepers maintain and balance accounts. So if you look at that like when you sit down to balance your checkbook and understand where all of your money went, that's the work of a bookkeeper. Versus an accountant, they will analyze those accounts for the overall health of the finance and review those records. Bookkeepers keep accurate records where accountants make financial forecasts based on records. Bookkeepers post debit and credits, which is just the term for recording individual entries. Accountants make yearly financial adjusting entries or monthly adjusting entries. Bookkeepers categorize documents for an income tax return versus an accountant who would prepare your tax returns. So bookkeepers do detailed work of accurately posting transactions and creating financial reports, and accountants analyze those financial reports, interpret them, and help you to make informed decisions based off of that data. The easy way to think about it is an accountant is a consultant for you. Basic accounting principles. Most everything that you're going to be faced with keeping your books revolves around the accounting equation. The accounting equation is simple. It is your assets are equal to your liabilities and your equity, and everything on either side of that equal sign must balance. You'll often hear the term double entry accounting, which is another way to represent the basic accounting equation. Again, it must maintain the balance. So in this example, we have a company that has assets that total $125,000 on the left side of the equal sign. And that is made up with $100,000 in liabilities and $25,000 in equity. So both sides of that equal sign are a total of $125,000. As an example, if the business goes out and wants to purchase a $10,000 piece of equipment using a charge account or credit, their assets would increase by $10,000. So at this point, in the middle of this transaction, the left side of our accounting equation equals $135,000, but our liabilities and equities on the right side only equal $125,000. So we are out of balance. So to deal with that, because we purchased it on credit, our liabilities also increased by $10,000 to give us $110,000 in liabilities. And now we see that both sides of that equal sign balance out. So that is the basic process of double entry accounting, basically saying that much like in science, every action has an equal and opposite reaction. What are accounts? Accounts are just buckets. They're ways for you to organize the monies in your business, whether that be rent, utilities, postage. They're just different ways for you to see in detail the financial health of your business. There are different types of accounts. One are the assets. Assets are things that are owned by the business and have value. Some examples would be cash on hand, inventory, equipment that you use to conduct business. Liabilities are debts or obligations owed by a business to creditors. Some examples there are accounts payable or loans. Equity are the owner's interest in that business. An example there is an account that would be called retained earnings. Revenue is the income that the business earns from its operation. And expense accounts are costs incurred by the business. Examples there, rent, supplies, salaries, utilities, etc. Each one of those accounts does something different. In the accounting equation, it may affect the left side of that equal symbol. It might affect the right side of that equal symbol. And it also affects different documents and reports that we'll talk about later. Your chart of accounts. That is very simply a listing of all the accounts that a business uses. An example is on the right, and you can see what a chart of accounts may look like. They're often organized with a numerical code to help recognize the account type. So on the left-hand side of the picture, you'll see some numbers. There's no rule to those numbers. They are just there as a different way for you to identify them. So that very first example, 1010 being a cash account, that again, it's just a code or a serial number. You can think of it like your social security number, and you know yourself as Dave or as social security number 123. You can assign whatever numbers you like to an account. I don't want to say they don't matter, but there's no rule that says that cash has to be called 1010. Another example of a chart of accounts, and you can see already that cash account on this chart of accounts has a different number. So again, you'll see some revenue accounts here. Could be service revenue, rental income, sales revenue. Expense accounts, again, could be cost of goods sold, rent, utilities. Liability example, it could be sales tax payable, salaries payable, mortgage payable. Equity could be the owner's initial investment, influx into the business, or retained earnings. And assets can be things like cash on hand and inventory stock. So if we're looking at this chart of accounts, we can see that, again, it just lists every single account that the business uses, and some that the business may not actively use. And oftentimes in that chart of accounts, you'll see if you look to the right, it will mention what type of an account it is into one of those 5 general categories: asset, liability, expenses, equity, revenue. Basic accounting principles. So again, transactions are recorded by keeping the accounting equation in mind. And when we're recording transactions, we're organizing the event into those different account buckets. Each penny of a transaction must be recorded into an appropriate account to ensure that your financial records are accurate. Double entry accounting that we mentioned earlier tells us that for every transaction, at least 2 accounts will be affected. You'll never have just one account affected. If you're just using one account, that's a great way for you to identify that there's a potential mistake getting ready to happen. A single transaction can also involve more than 2 accounts. So you may see a complicated transaction that could touch 20 accounts in a rare example. The accounting cycle. So we're going to walk through and spend a lot of time with this because the accounting cycle really explains the ebb and flow of a period of time for our business, usually broken out throughout the course of a month. Most businesses will keep track of their books in those snapshots of time. And so in a single snapshot of time, you will work through this accounting cycle each time, whether that's a month, whether that's a year, or so on. So the first step of the accounting cycle is to analyze transactions. And that is simply to look at each individual receipt, each individual transaction, and understand what's going on. Step 2 is to post that transaction to a ledger account. So when you pick up a single receipt for a transaction that occurred, whether it was a purchase of supplies for the business, you will, again, analyze that. And then once that analyzation is done, you're going to post that to your ledger account. So if you're using software like QuickBooks, that would be where you would sit down and make an entry. Once you've gone through and you've analyzed all of your transactions, posted all of the transactions to the ledger, you will then prepare a trial balance. And again, we'll get into each of these in more detail. A trial balance shows interim results of all those posting activities that you've done. And this is a time that it'll allow you to review for errors that may have been made. If you do identify any errors in step 3, then step 4 is to create adjusting entries, which correct those mistakes. Step 5 is to create an adjusted trial balance, which again is just a repeat of step 3, taking into account any of those corrections so that you get a final look at anything that might need to be done before you proceed to step 6, which is to prepare your financial statements. So a little bit in practice, and we're going to look at steps 1 and 2 of the accounting cycle. So in this example, we're going to purchase some inventory from our vendor on our charge account. We need to identify what accounts are affected, total those accounts. So the first thing, we have this receipt, and we're just going to analyze it and perform step 1. Here we can see that we bought $5,000 in widgets and $1,100 in gears for a total of $6,100. So analyzing that, we need to identify what accounts or what buckets are affected here. And in the very beginning, we again have 2 accounts that are affected, never less than 2. And in this case, it's very straightforward. We've purchased some inventory and we've purchased it on account, so we're going to owe our vendor some money at some point down the road. Analyzing that, we understand that all $6,100 of this transaction is inventory. And again, we owe our vendor $6,100. So step 2 of that accounting cycle is to post the transaction to the ledger. And we would create entries, journal entries typically, to organize this transaction into those individual buckets. Few days go by, and it comes to the end of the month, and our vendor would like, sorry, I'm skipping ahead a little bit there. Showing this a little bit differently, we can see where this shows up on the accounting equation. So that $6,100 in inventory is an asset to the business. We owe the vendor $6,100, and because we owe someone money, that is a liability to the business. And if we put that together, it's very straightforward in the accounting equation. Assets equal liabilities plus equity. In this case, our $6,100 in assets equal our $6,100 in liabilities. So the equation is in balance. Fast forward a little bit, and that vendor would like us to pay them. So the vendor sends a bill for the inventory that we purchased. In this example, we are going to pay the vendor with cash. Now, cash is an asset, and if we have asset leaving the business, then our assets will reduce by $6,100. And because we no longer owe our vendor money, our liabilities reduce by $6,100. And again, in this small snapshot, that accounting equation stays in balance. Let's say that we want to borrow $10,000 from our line of credit because we need a little bit more cash on hand. We had a lot of bills to pay this month. In this example, our cash is going to increase by $10,000, again, cash being an asset. And we're going to loan we're going to owe our lender for that loan. So that's a liability in the amount of $10,000. And again, both sides of that equation balance. Getting a little bit more complicated, again, every transaction will have two accounts that are affected at a minimum, but could have many more. So let's look at this example where we're purchasing a piece of property for $200,000, and we're going to put $40,000 in cash down and finance the remaining $160,000 in a mortgage. So first off, we're purchasing an asset. The property or land that we've bought is worth $200,000, and so our assets will increase by that much. We're going to owe the bank $160,000, that being a liability. Now, if we were to stop here and total this transaction, we would see that our assets are equal to $200,000, our liabilities equal $160,000. That accounting equation is not in balance. So we have a little bit more work to do. Finally, we used $40,000 in cash. Cash is an asset for the business. We're removing it from the business, so our cash reduces by $40,000. And now if we check, we can see that the accounting equation balances $160,000 on both sides of that operator. As we work through the accounting cycle, that again is an example of the first two steps, analyzing the transactions and posting them to the ledger. We'll talk a lot more about the individual steps in detail as we go through this course and the next course. But ultimately, everything that we do is going to ultimately build up to financial statements that allow us to analyze our business and allow lenders and maybe a potential purchaser to do some research in our business to see the health of the business. There's two main documents that show us what's going on with the business. The first is the income statement. You might also hear that referred to as the profit and loss statement, or P&L, and the balance sheet. The income statement simply shows for a given period of time, and you can look at an income statement for any range of time that you'd like. Typically, they're looked at on a monthly basis and then often rounded up on a year-to-date or annual basis. But it simply shows all of the individual activities that occurred within that time period that affected the income statement. Some transactions will affect the income statement, some will affect the balance sheet, and so on. But basically, money's in and money's out for revenue and for expenses are what will hit our profit and loss statement. So in this example, we have Paul's Guitar Shop, and they've done some merchandise sales and some music lessons throughout the period for total revenues of $27,800. Now, if we look, we can see that $27,800 was made up again from some merchandise sales and some music lesson income. And what we're looking at is the total of the two different accounts, two different revenue accounts, one being merchandise sales, the other being music lesson income. And each of the individual transactions that we've posted into that bucket throughout the period are being totaled up onto the profit and loss statement. So if we were using our piece of software and we were wondering where this $3,000 came from in music lesson income, we could drill into the individual transactions that we've posted to see each and every one of those. In the same period of time, we had expenses that occurred. The merchandise that we sold, we had to pay for that. Hopefully that we sold it for more than we paid. And in this case, Paul's Guitar Shop did that. So they had cost of goods sold of $10,000. And again, just to belabor that a little bit, that cost of goods sold is the asset side of the inventory that you purchased, your cost, and the merchandise sales are what you sold them for. So again, hopefully that number is more on the merchandise sales than on the cost of goods sold piece. Depreciation expense here for Paul's Guitar Shop was $2,000. Depreciation is something that you use to keep track of your assets diminishing in value. So if you were to purchase a new car at the dealership, second you drive it off the lot, it depreciates and it loses half its value, quote unquote. That is recorded in on the balance sheet as well as on the profit and loss statement in an accountancy as a way to keep track of the value of an asset and to work through its useful life. Paul had to pay his employees $750. He rented the store for $500, had some interest expense, supplies, and utilities. So throughout the period, Paul had to spend $14,850 to operate his business. And if you take a look at the revenues of $27,800 minus all of the expenses of $14,000, Paul had a net income of $12,950. And that's what our income statement shows us, as an income or a loss after we look at all of our revenues and expenses in a period. This document is really great to analyze how your company is performing over a specific span of time. Again, whether you wanted to look at it in a small month window, look at it for a year window. A lot of times it's really good practice to look at it for a whole year, but with each month laid out. So you can see if an individual expense line goes up or down, has some peaks and valleys. And it allows you to investigate areas for improvement, such as better expense control, a need to raise prices for better gross profit, and really understand your business and make educated decisions. The balance sheet shows us effectively the net worth of our business. And the balance sheet shows the company's assets and liabilities and equity. Again, it's great for understanding the net worth. In this document, you can see the accounting equation at use. So in this document, the first area are our assets, and it breaks out all of the assets. And in this example, that equals 11,310. And then you can see the liabilities broken out for $6,300 and the equity for $5,010 for a total of $11,310. So again, your assets are equal to your liabilities plus your equity, and both sides of that accounting equation will always balance. So this is a really good way to help solidify the understanding of that general thought process between the accounting equation. Why is all of this important? It sounds very boring. I'm trying to run my business. I'm Paul's guitar shop. I've got music lessons to give. I've got drums to sell, new parents. Well, it's not only required, but it's a good idea. Again, it allows you to understand if your business is succeeding, if your business is struggling. It lets you make informed decisions by understanding what's coming in and going out. If you're working with an accountant, your accountant can also help make that informed decision and be that consultant for you. It facilitates obtaining loans and financing. Lenders are going to want to know how the business is doing. Common struggles, we've talked about it a little bit. You're too busy running your business. There's only one of you. You're often focusing on the core of what you do best. Whether it's selling those guitars or baking, or if you're a landscaping business, you're mowing and you're creating beautiful lawns for folks. Lack of bookkeeping knowledge. I think most of us, don't think about bookkeeping. We don't wake up in the morning and say, man, I really want to get out my slide rule and my pocket protector and analyze the receipts from Lowe's last month. We opened our business to be that guitar salesperson, to be the landscaper, to be the baker. And we didn't necessarily go to school or learn how to do these things as our main piece of knowledge. You're the pro at your widgets. You're probably less skilled at keeping the books. Difficulty keeping organized. There are so many transactions, whether you're a Fortune 500 company operating globally or you're a small one-person sole proprietorship. It doesn't matter. There are thousands of transactions in any given month. Every single thing that happens that affects money or equity is a transaction. They come in different formats. They come every which way. You might get an e-receipt You might have to log in and get a statement from your vendor. You might have wadded up receipts in your pocket from shopping throughout the day. That went a lot quicker with all the examples in there. So I want to open it up for some questions. We covered a lot of content. And again, I want to remind everyone that we're going to get into more detail through the remaining steps of the accounting equation in our second series.
Again, feel free to put questions in the chat if you have them, and I will read them out loud, but everybody now has the ability to unmute themselves if you have questions that you would like to ask out loud. While we wait for folks to come up with questions, Michelle, if you're still on the call, would you want to talk a little bit about, introduce yourself and talk a little bit about what the SBDC does?
I'm here, finished with my lunch now, so you don't have to watch me chew. So the Small Business Development Center is kind of a unique combination of resources. We get most of our funding at the federal level through the Small Business Administration. And then we also get funding from New York State with support from the SUNY system as well. So we have 22 centers in New York State, all of them affiliated with a SUNY campus for the most part. And so all of our services, because of those funding resources and because of the support from SUNY, all of our services are free. So we provide one-on-one counseling to businesses at all levels of development. So if you wanted to come and talk to us about starting a business, or if your business is growing and you have certain challenges that you want to work through, or if you're looking for some information and resources on a certain topic or a certain, something that you're dealing with, we can do all of those things. The only thing that we don't do is we don't offer legal advice, and we don't do accounting. So, I'm really happy to see this programming. I know that bookkeeping is probably one of the least favorite parts for most people of entrepreneurship. And so because of that, it gets pushed to the side a lot. But there are some very big benefits to maybe not having the skills to do your own bookkeeping necessarily, but to have an understanding of what this all means, so that when you are working with your accountant or your bookkeeper or your SBDC advisor, that you know what your profit is for your business, and you know what your cash flow is, and you know what your balance sheet looks like and what that means. So I think one of the scariest parts with bookkeeping is people feel like they have to have the same level of knowledge and skill maybe that an accountant would have. And that's not necessarily true, but I do think it's important to understand all of those concepts and, finding the support through a bookkeeper or an accountant to kind of help you keep on track. So kind of back to the SBDC, that was just my little plug to you probably listen to this, you're like, oh God, I'm lost now, but stick with it because it's important. But the other thing I think I want you to know about the SBDC is that we do cover pretty much the top half of the North Country area. So we cover St. Lawrence County, Franklin County, Akwesasne, Clinton County, and some kind of outlying areas as well. We have offices at SUNY Canton and also at SUNY Plattsburgh. And so all of those things, I think, combined with your bookkeeping and with your accountant, we hope to kind of be a partner in your management team to help keep your business successful.
Great, thank you, Michelle. And we do have some great questions coming in the chat as well. So I'm just going to read them aloud in the order they came in. And then if you want to elaborate on the question you asked when I get to your question, feel free to speak up and do so. So first, what are best practices for making sure your chart of accounts is optimized? And Tyler, if you want to elaborate on that at all, feel free to speak up.
That is a great question. And yeah, Tyler, if you do want to unmute and jump in, feel free. Very great. Go ahead.
Thanks, Dave. And I'll just clarify, the chart of accounts are often inherited from previous business owners, or you're setting them up without a lot of context. So making sure that that is organized as far as a best practices benchmark is concerned. That was the clarifying question. Thank you.
Yes, very, very great question again. So whether you are inheriting a business or purchasing a business, and you're all of a sudden faced with a chart of accounts and years of bookkeeping transactions from a previous owner, and maybe they had a little bit different of an idea on how they wanted to organize things than you. And even when you're starting fresh and you use software like QuickBooks, they will give you a default regurgitation, for lack of a better term, of accounts that they think your type of business might use. So we'll address at least best practices for your question in general. Is one of the things we're going to talk about are things called trial balances, again, in that accounting equation, and the balance sheet. And those are two things that would really help us out to analyze the existing chart of accounts. So your balance sheet is going to show you a good portion of accounts that may have values in them, and you can drill down from that point and see, okay, what are these things that the previous owner put into the rent? Well, you wouldn't see that on the balance sheet, but what are some previous pieces of equity and whatnot in there? Another thing is to look at the individual trial balances for all of your accounts. And as we're going through that accounting cycle, one of the things we do is we run trial balances for every single account on the chart of accounts. So any account that would have a balance in it would be shown, and you can drill down. So I would look at those two reports to get started, and first of all, just understand where everything is. And I am a person that likes to have less noise around. So the first thing that I tend to do is delete things that I don't need. Now, I'm not telling you to blindly go in and delete things you just don't like in your accounts, but to do that analysis, and to, if there's an account that you don't use, there's no activity in it, you don't know what it's for, if you're using a piece of software, simply delete it. Most software, if it's a required account for whatever reason for the software to function, it wouldn't allow you to delete it. But when I create a new QuickBooks file, that is the very first thing that I do, is I delete all of the accounts that I don't think I'll use. So in general, to kind of circle the drain a little bit, is to understand all the accounts that are there, and to get rid of the ones that you don't use, and then feel comfortable renaming things. You can also get involved with cleaning them up. So maybe we make some adjusting entries to take things out of an account that you don't like and put them into an account that you like better, or to group things together and use less accounts. In QuickBooks Online, one of the funny things is they restrict the number of accounts you can have, and that drives some people crazy. But you'll often hear accountants and bookkeepers say you shouldn't need a massive list of accounts to operate your business. So hopefully I didn't make that understanding of that question worse for you, Tyler.
All good. Thank you, Dave. Appreciate it.
You're welcome. And go ahead, Mahela.
Oh, go ahead, Dave.
I was just going to say I can read the next one if you'd like.
Yeah, go right ahead. I have Rebecca's question next from the chat.
Great. So yes, confusion about the meaning of equity, and what are some examples? So Rebecca, did you want to expand on that at all, or let me ramble? I'm good at that.
Mute. Okay. Trying to unmute. So I think equity is what you as an owner put into the business, is what I thought it was, but isn't that just a loan? And wouldn't that be a liability back to myself?
That is, honestly, you're kind of right in both cases. So yeah, equity is what worth or what value is there above and beyond obligations. So if you think about it in terms of purchasing a home, and in that example that we use in the class of purchasing a home for $200,000, putting $40,000 down and taking out a loan for $160,000, in that example, you have property that's worth $200,000, but you only owe $160,000. So that difference is the equity. That's what that home is worth above and beyond. If you were to turn around and sell it for the exact same amount for $200,000, you would get your $40,000 back. And as you pay off the loan over the course of that mortgage, your equity continues to grow and your liability continues to decrease. So in the case of owner's equity, there's different reasons where an owner could loan money to the business and have it truly be a liability. But oftentimes you'll see that an owner, especially when you're purchasing a new business, and you're just injecting money into the business, where we treat that as equity. But it's kind of interesting that you frame it that way, because you can truly look at it kind of both ways. But the difference could be is maybe you open a business and as an owner you put in $100,000, and we'll just say that that's your equity. It truly is. But you operate for a few months, and like many new businesses, you tend to operate at a loss. You've got big bills to pay. Maybe your customer revenue stream isn't quite there yet, and you operate for a few months and you lose $10,000. Well, that $10,000 had to come from somewhere, and so you might find that a few months into operating that business, that instead of $100,000 in equity, you may only have $90,000 in equity. Again, looking at all those things, really everything balances out. If you lose money in a given period, it has to come from somewhere. And hopefully you're operating at a profit eventually. And that is the inverse of that. So as you make money, if you don't withdraw that from the business, you increase that owner's equity through accounts like retained earnings and so on. Did I help you with that, or you want to have any more questions with it?
I think it helps a little bit. I just wanted some more examples of what equity is too, other than just owner's equity. For example, I'm working out of my home and I have a home office. Now that was my home, but then it's also now the office. How does that work out?
Sure. So, to that question you just asked is much more of an accountant-based question, because that gets into taxes. So you physically working out of your home, if your home isn't owned by your business, then that is not something that would affect owner's equity. However, there could be examples, again, working with your accountant to find out what that dollar amount should be and how to properly record it and file it with your taxes. That use of your personal office space can be an expense of your business. So your business maybe should pay you rent to offset some of the income that you're making off of the business. So it doesn't necessarily affect equity, but it's a good conversation to work through exactly how you want to record it with your accountant, because there is value there. And certainly your business shouldn't get a free lunch, so to speak, of being able to use a room in your house without any benefit to you. Some other examples of equity, again, owner's equity, your initial injection into the business. Maybe you give the business some more money throughout the course of its operation. An example of equity in your example would be maybe you sell your house to the business, and now the business does own the house. The equity that was in your house is now a form of equity. So equity is the difference between the value of any asset that is worth money and any liabilities that are due against that asset. So whether it's a car, inventory in a lot of ways is equity. It's recorded as an asset, but it's really just a math equation of how much stuff do you have from a worth standpoint and how much money you owe on it. And so if it's a tangible item like cash, and you have less obligations against it than it's worth, then that difference is equity. And we could definitely talk more too offline if you'd like as well. Sometimes I get, spinning my wheels in circles a little bit, trying to give some examples and make it worse. But
I think that last statement that you just said, if you owe more on it, or you owe less on it than what it is, the other half that you have already paid off, that is a tangible equity of that.
absolutely.
That desk or something that you bought, it now is owned by the furniture or something, like, is equity if it's already been paid off.
Absolutely. Yep. That is
Okay.
correct.
All right, thank you.
You're welcome.
I'm actually going to combine the next few questions we have in the chat because I think they all kind of go together. First, is there going to be coverage of QuickBooks in this program? And that will be our third session. So our second session will be a follow-up to this session, and then the third session will be an intro to QuickBooks, and I'll let Dave elaborate on that if he has anything to add. And then similar vein, we have two questions. Do basic spreadsheets programs work well for doing your own bookkeeping, or would a QuickBooks-like software provide big advantages? And then similarly, what is the best way to capture transactions in a digital way?
Yes, thank you. So not much to expand on about our third session. The intention there is to give an overview of QuickBooks and maybe be able to answer some questions for some folks that use QuickBooks, but also really just to give a high-level overview of what QuickBooks is and how it operates for a new user that may not have it. So Christopher's question of, do basic spreadsheet programs work well for doing your own bookkeeping? And I would say no. That's nothing against a spreadsheet program. I love Excel. I can do some really amazing things with the software, just to pat myself on the back, I think. But I would never try and keep my books in a spreadsheet program. I've had quite a few people that have tried to do it, and some people that do it relatively successfully. And you certainly can organize all of your different transactions and understand that here's how much I have in revenue in a period, and here are my expenses in a period. And you can write some very fancy formulas and so on to do that for you. But again, going back to that thought process of double entry accounting and how every single transaction affects no less than 2 accounts, and some transactions may affect 10, 20, or 30 accounts. Everything you do has that equal and opposite reaction. And so, if you go to Lowe's and you purchase something for the business with a credit card, you've got to record an entry for the purchase of those expense items. You've got to record an entry for the transaction on the credit card. Then later on, you've got to record a transaction for paying the credit card and a transaction for the cash that you use to pay that credit card. Then you have to be able to tell that software, does that affect the balance sheet? Does that affect the profit and loss statement? It's a lot of work. And if you're going to put in that amount of work into a spreadsheet program and writing software and developing reports, you might as well put that effort into some software that would do it for you, just because there's other people that have done all that work for you on the back end. I'm not sponsored by QuickBooks or anything like that. In a lot of cases, I'm not a fan of QuickBooks, but it's certainly one of the most popular out there. And I think one of the better choices there are for people to use, unless you're in a huge business where you can afford some very, very expensive piece of software. But a lot of people have a love-hate relationship with QuickBooks, and I'm certainly one of them. But QuickBooks is an example of something that can do all of that work for you. You have to understand QuickBooks. You have to use it properly. Otherwise, you'll be more on that hate side of the feeling. But it can definitely do a lot for you. So I won't say outright no, because I've seen some people do some cool stuff in Excel and Google Sheets and so on. But me personally, I would stay away from it.
Any further questions for Dave?
Was he going to answer the other part of the questions that you had?
Sure. Best way to capture transactions in a digital way, whether
Yes.
that's QuickBooks or something else that you prefer.
Yeah, so thank you for reminding me of that, Rebecca. Did you, just to clarify, were you looking in terms of like recording things into QuickBooks as an example, or were you trying to get at something else?
Well, you said though that that's probably the most complicated thing is all the different transactions that you have. And what is the best way? I mean, I didn't see in QuickBooks if there was an easy way to get a digital receipt. We have these cell phones now, and we have ways of keeping track of where we went and what we did there and who we shopped with. And is there a way to connect all of those things together so that I don't have to keep typing stuff in?
Yes and no. I wish I could easily say yes to that question. My personal best practice is to have a quote unquote an inbox for all of those things. So as I run into a receipt throughout the day that I might buy on my credit card, I personally use Dropbox is a cloud-based My Documents folder, so to speak. So I have my phone set up that I can take a picture of a receipt and it automatically puts that receipt in my Dropbox folder. But what I tend to do is I have a folder in my computer, and any transaction that I get my hands on, whether it's a picture from my phone of a receipt, or I get emailed an invoice or a statement from a vendor, I put those things in that folder, and that's how I work, where I work from. So I know that if there's something in that folder, I've got work to do, and if that folder's empty, then I'm hopefully caught up. But there are certain integrations, depending on how involved. QuickBooks is an example. There are bank feeds for QuickBooks where you can link your credit cards and your savings account, your checking account, and different types of account with QuickBooks, where they will, if they see a transaction come through on your credit card, it will, I won't say make a to-do list, but it'll start an entry for you to say, hey, Rebecca, you purchased $29.95 at Lowe's. You need to do something with that. So that's one way that if you wanted to create some integrations between your software that you might be using and your individual accounts, that's one that I've seen some folks use is that QuickBooks integration with, I think they call it bank feeds is what QuickBooks calls it.
Okay, well, I like the idea that you take a picture of your receipts. There's probably some kind of word recognition that can turn those individual because the bank doesn't know what was on the receipt, and that's the key, is that you need to know, you have to add something to your inventory or whatever so that you put it in the right equity, or if it's paid for, all of the right columns. That there is some word recognition software to maybe convert that into an easier way to add into QuickBooks. And you haven't heard of anything like that, have you?
There's in terms of direct integration, I can't speak to anything that I've personally run into. There absolutely is software out there that if you were to take a picture of a receipt, that there's some optical character recognition where it might read that item and be able to have some kind of machine learning there that says, hey, we recognize this as being that. There's some expensive software out there that, if you were to scan a receipt in, it can recognize that, oh, this is your utility bill. And I know that the utility bill should affect utilities and accounts payable and so on. I haven't seen necessarily where a lot of those are integrated to what I'll call a consumer-based software like QuickBooks. Usually when you get into that level of integration and machine intelligence, you're working with something that's, again, a very expensive piece of software, because you can imagine a Fortune 500 company with millions of transactions in a month. They're always looking for ways to automate and take a human piece out of it. But what I can say is in QuickBooks, where when you are, even whether or not you're using that bank feed, you can create templates so that if you have that utility bill come in, you can teach QuickBooks to say, okay, great, here's my Con Edison bill, my National Grid bill, whatever it might be. And typically that bill affects utilities as an example. And so you can teach that to QuickBooks a little bit. And if you do have that bank feed there, when you pay that electric bill, it can kind of start to create that transaction, put National Grid in as the vendor, put your utility account into the ledger, and it can read that amount because it had that bank feed, so it knows how much the debit was for, and start it for you. And depending on your level of trust, if you try it for a little while, you can even give QuickBooks the go-ahead to automatically record that transaction when it comes in. So if it's something straightforward like your utility bill, and you're comfortable with it, saying, okay, I got a $200 bill from National Grid, that's utilities, you see it, you record it, and you move on with your life. And then you can catch it later on when you do your review of your profit and loss for the month, and say, oh, geez, there's this crazy amount in my utility bucket, let me drill in there. So again, I feel like I should be on QuickBooks payroll, but as an example, QuickBooks has some of that ability where you can work with it. It's just not as intelligent as, your self-driving Tesla to, we're going to do all the work for you, but you can work with it and have it help you quite a bit.
Okay. Well, there's companies like Lowe's, they send you a receipt in your email, or you can request an email receipt. That's the type of thing I was talking about, but there's no way to convert that receipt to some kind of already typed in digital, so I don't have to type it. I think I'll look into it more, but thank you very much.
Yeah, absolutely. No, it's I've seen it happen in general with some, like I said, more sophisticated software, but not necessarily easy. There are third-party companies out there, bless you, Danny, with some integrators where they're not a part of QuickBooks, they're not necessarily endorsed by QuickBooks, but they can get in on the backside of it and write some coding and so on. And if you do some searching online, you may find some companies that might have something a little bit more of what you're looking for. And I definitely get where you're going. But it just depends on how much development time you want to pay for a lot of that stuff. And it might be worth it for you.
And I think I've had a few clients use Wave accounting, and I think that allows you to scan receipts. And I think that that's compatible with QuickBooks. I think you can upload that to QuickBooks. Don't quote me on that. Check it out to be sure. But I think that's one, and I'm sure there's some others, but that's just one I know I've had clients mention to me before.
Yeah, that's a great point, Michelle. And that's where, I was kind of fumbling for the term for it, but yeah, finding an integrator that would be able to bolt on to QuickBooks and provide that service, or whatever software you're using.
Great. Thanks, Michelle, for adding that in. We'll be sure to look that up and share it out in the follow-up email after this program. And it is 1 p.m., so I think we'll go ahead and wrap up. If you do have further questions that come up, feel free to send us an email and we'll pass them along to Dave. And yeah, thank you everyone for coming. And Dave, thank you so much for putting on this program. This was really great. I know this is a topic that can be intimidating and overwhelming. So thank you for sharing all of this expertise with us. And thanks, Michelle, for joining as well and sharing about your resources. The next program in this series will be 2 weeks from today on Thursday, July 13th, the same time on Zoom. In the coming days, by early next week, hopefully we'll share out the recording of this and the slides so that everyone has access to it. And we hope to see you on the 13th. Thank you, everyone, and have a good afternoon.
Thank you, everyone.